cost of your summer vacation, the actual legality of your phone's data plan, and, I mean, even the fate of Jennifer Lopez's 24-bathroom mansion are all currently being dictated by the exact same invisible market forces.
Yeah, it sounds crazy when you put it like that, but it's true.
Right. Today, you are plugged directly into NovaStream. This is our 24/7 live YouTube streaming channel where we are tracking global financial indices, live crypto markets, and breaking news the absolute second it hits the wire.
Exactly.
And when you look at a raw, unedited dashboard like the one we are broadcasting right now, the artificial walls between geopolitics, finance, and culture, they just completely disintegrate.
Which is exactly why our mission on this deep dive is synthesis.
Yeah.
We aren't just here to, read the headlines scrolling across the bottom of the YouTube player.
Yeah, anyone can do that.
Right. Anyone can stare at flashing red and green numbers all day. We're here to pull on the threads connecting a global military conflict to a corporate balance sheet and to the domestic legal battles over your personal data. And yes, even to the absolute financial trap of celebrity real estate. We are looking for the mechanisms behind the movements.
Okay, let's unpack this. Because the biggest, reddest flashing light on the NovaStream dashboard today is coming straight from the commodities market.
Oh yeah, it's impossible to ignore.
It is. And it is dragging the entire global aviation sector down with it. We really have to start with oil. And the geopolitical shockwaves stemming from the United States and Israel strikes on Iran that began back on February 28.
Yeah, to truly grasp the magnitude of what the energy markets are processing right now, we really need to look at a sobering new analysis from UBS.
This is the one led by Banu Bawija, right?
That's the one. They looked at this current oil supply shock and basically scanned the last 50 years of historical market data just to find a parallel.
And what did they find?
Well, the closest match they could find for this level of disruption is the 1990 to 1991 Gulf War.
Wow. I mean, comparing anything to the Gulf War energy crisis is going to send a chill down the spine of any institutional investor.
It absolutely should. I mean, the underlying numbers are staggering. UBS points out that in the first 2 to 3 months of the Gulf War, oil prices rose by about 80%.
Okay. And what about our current episode?
The data shows a spike of almost 100%. The price of energy has essentially doubled.
That is insane.
Right. And according to this UBS analysis, the absolute best case scenario right now, like the most optimistic view, is that oil manages to stabilize somewhere in the mid $80 per barrel range.
So imagine you are running a company whose entire daily operation relies on burning millions of gallons of aviation fuel. You are waking up to a completely destroyed financial model.
You're just in a nightmare scenario.
Exactly. Which brings us to the immediate corporate casualty flashing on our breaking news feed right now. Alaska Air, the parent company of Hawaiian Airlines and Horizon Air.
Yeah, they just dropped a bombshell on the market.
They did. They completely halted their full-year earnings guidance.
And, when a massive publicly traded company halts their forward guidance, they're publicly admitting to Wall Street, we are flying blind.
Right.
They're saying, we cannot accurately predict our own financial future because our input costs are entirely out of our control.
Let's break down the math they released because it is just brutal. They are looking at an extra $600 million in second quarter fuel costs alone.
Just for Q2.
Just Q2. To put that into market terms, the feed notes this equates to an earnings per share headwind of $3.60.
That's a massive hit.
It is. And for anyone who doesn't stare at corporate balance sheets all day, earnings per share, or EPS, is basically the fundamental metric of a company's profitability. It's the total profit divided by the outstanding shares.
Right.
So a sudden drop of $3.60 in EPS means the fundamental value of the company is taking a massive, unavoidable hit.
If we connect this to the bigger picture, you start to realize how macro shocks instantly rewrite corporate reality.
Yeah.
I mean, that $600 million unexpected expense wipes out their entire profit from the last 2 years combined.
Oh my God. 2 entire years.
Gone. Every single ticket sold, every bag fee collected, every in-flight ginger ale sold across Alaska, Hawaiian, and Horizon over the last 24 months is just gone. Burned up in a single quarter's geopolitical fuel spike.
It really makes you wonder how fragile the broader transportation sector's baseline really is right now. I mean, if an airline can lose 2 entire years of profit, due to a single quarter spike, it's wild.
It is.
An airline is essentially a flying hedge fund. They aren't just selling you a seat, they're constantly placing massive financial bets on the future price of oil.
Exactly.
So when oil doubles in a month, it's not just a budget overrun. It's like their entire bank account has been seized to pay the gas bill.
That mechanism is exactly why companies in this sector are forced violently out of growth mode and entirely into survival mode.
Right, you cancel route expansions, you delay
You
hiring.
hoard cash. The inherent leverage in the aviation system means these companies are basically massive financial instruments balanced precariously on the price of a barrel of Brent crude.
But check out this fascinating contradiction popping up on the global indices feed right next to the Alaska Air bloodbath.
The GE numbers.
Yeah. The commercial airlines are bleeding out, but the aerospace manufacturing sector is actually soaring. GE Aerospace just reported their Q1 earnings, and they didn't just beat expectations, they crushed them.
Yeah, their shares rallied into positive territory for the year early this Tuesday.
Right. But I mean, why?
Well, they're building the physical engines for the planes that the airlines suddenly can't afford to fuel. But notice the crucial nuance in the NovaStream feed regarding GE's forward-looking statement.
Okay.
Their outlook is trending toward the high end of their guidance, but the company is officially describing it as tempered.
See, I have to push back on the market's optimism on GE here. I mean, so GE had a blockbuster Q1, sure, but they are essentially looking at the exact same NovaStream data we were out for high oil and slowing growth and bracing for impact.
Yeah, they are.
Are they just the last domino to fall? The airlines feel the fuel shock instantly at the pump today, but GE is going to feel it 3 years from now when the airlines inevitably cancel their engine orders to save cash.
That is the physics of corporate momentum at play. Manufacturing has an incredibly long tail.
Right.
The engines GE delivered and got paid for in Q1 were ordered years ago, so their current balance sheet reflects the economic optimism of the past. But that tempered guidance, that reflects the reality of the present. GE anticipates Brent crude staying highly elevated all the way through the third quarter, combined with reduced fuel availability.
So they see it coming.
They absolutely know the shockwave is traveling through the supply chain. It hits the operators today, it hits the manufacturers tomorrow.
Wow. Okay, so we're watching global economic headwinds slow down physical trade and physical transportation. Now let's shift to the friction happening in the domestic digital landscape.
This is a huge shift.
Because while airlines are battling the oil markets, the massive telecom companies are battling the federal government at the Supreme Court over your consumer data.
This is a monumental case regarding administrative power versus constitutional rights.
Right.
The Supreme Court is officially reviewing the FCC's enforcement power against communications companies.
Let's lay out the facts hitting the feed. The FCC penalized two of the biggest players in the game, Verizon and AT&T,
Right.
with millions of dollars in fines.
Mm-hmm.
The agency's stated reason was that these telecom giants allegedly failed to protect consumer information and failed to combat robocalls.
Right, and if you were sick of getting 5 scam calls a day during dinner, this is the agency that is supposed to be punishing the networks letting those calls through.
Exactly. But historically, the FCC has relied on these hefty administrative fines to enforce rules as a watchdog. But Verizon and AT&T did not just pay the fines.
No, they fought back.
They sued the government, and their argument hinges on the 7th Amendment of the U.S. Constitution. They contend they were deprived of their right to a jury trial because these millions in financial penalties were imposed unilaterally by an administrative agency rather than by a jury of their peers in a federal court.
And the reason the Supreme Court actually took this up is because of a massive legal precedent established just 2 years ago.
Right, the SEC case.
Exactly. The conservative majority on the Supreme Court rejected a very similar practice by a different agency, the Securities and Exchange Commission.
And what were they doing?
The SEC was using its own in-house tribunals, basically their own internal administrative judges, to enforce rules against securities fraud.
Oh, wow.
Yeah, and the Supreme Court ruled that the SEC's practice violated the right to a jury trial for the exact same reason.
So AT&T and Verizon are leveraging that exact precedent.
They are. They are arguing that if the SEC cannot act as judge, jury, and executioner without a real jury trial, then the FCC cannot unilaterally levy millions in fines either.
Now, looking purely at the data on the feed, and maintaining strict impartiality here regarding politics, it is crucial to note that the Trump administration is actively defending the FCC's use of these administrative fines in front of the court.
Yeah, that's an important detail.
They are officially viewing these penalties as one of the government's most important and frequently used enforcement tools. Again, we're not taking a stance on the politics here, just purely laying out the tension between administrative state power and corporate constitutional arguments.
This raises an important question. How do regulatory bodies actually enforce consumer protection moving forward if they lose the ability to unilaterally impose financial penalties?
It's a great question.
I mean, the corporations are arguing for basic constitutional fairness. You can't take our money without a trial. But the regulatory agencies are arguing this will absolutely paralyze their ability to protect your data.
Because trials take forever.
Exactly. Federal jury trials take years and cost a fortune. If every single data privacy infraction requires a full trial, the friction of enforcement becomes impossibly high.
It is a massive tug of war between the power of the administrative state and corporate constitutional argument.
Definitely.
So traditional physical markets are choked by geopolitical oil shocks, and major digital corporations are bogged down battling the federal government in court for years over fines. But there is one place on the NovaStream dashboard where capital is flowing entirely untethered. Let's look at the live crypto markets.
Oh, yeah. We are seeing the exact opposite of that physical and regulatory friction here.
Completely untethered.
The total cryptocurrency market capitalization, the total ticker on the board, just added $58 billion in 24 hours.
Wow.
It's currently trading at $2.53 trillion.
And the technical analysis auto-populating on the chart is laying out a very specific scenario. The broader market is looking for a clean break above what's called the 0.5 Fibonacci level, which sits right at $2.60 trillion.
Right, the fib level.
Yeah, and for those who don't spend their days staring at candlestick charts, a Fibonacci level is basically an invisible mathematical line that traders use to predict where a price might naturally bounce or break.
It acts as a psychological tripwire for the entire market.
Exactly. If it breaks that 2.60 shilling, the bull rally gets fresh momentum. If it fails, the support level sits between 2.46 trillion and 2.60 trillion, and the altcoins are going to remain incredibly choppy.
And looking at Bitcoin specifically, BTC is up 2.68% today.
Not bad.
No, not at all. The bulls are fiercely defending a critical support zone between $74,000 and $75,000. And notice where the 100-day simple moving average is resting.
Where?
Exactly at that $74,000 mark.
Okay, let's explain why that matters. The 100-day simple moving average is literally just the average price of Bitcoin over the last 100 days.
Right.
But because millions of trading algorithms and human day traders look at that specific metric as a baseline for fair value, it becomes a self-enforcing floor.
It's all psychology.
Exactly. When the price dips to 74,000, automated buy orders kick in because the crowd collectively believes it shouldn't drop below its recent historical average.
But, while Bitcoin consolidates and establishes that floor, the real standout on the board, the asset capturing the most aggressive liquidity today, is Concoin.
TON is just ripping today.
It really is.
Yeah.
TON is leading the entire top 100, up 6.29% to $1.37.
And Toncoin's chart shows a classic breakout mechanism. From February through mid-April, it was stuck in what traders call an accumulation zone between $1.18 and $1.35.
Right.
An accumulation zone is essentially a period where the price trades sideways, usually because large institutional players, whales, are quietly buying up massive amounts of the asset without spiking the price. Finally, on April 11, it broke through that $1.35 ceiling.
And in technical analysis, old ceilings become new floors.
Yep.
So TON has to defend $1.35. If it holds that level, the feed's next target is a push toward $1.50 to $1.51. That specific target is vital because $1.50 is heavy psychological resistance. TON faced hard rejections at $1.51 on both February 14th and April 11th.
Here's where it gets really interesting. We talk about these Fibonacci levels, moving averages, and psychological resistance targets like they are immutable laws of physics.
Right.
But are levels like the $1.50 Toncoin target essentially self-fulfilling prophecies created entirely by the crowd's collective psychology?
They absolutely are, and that is the pure essence of market mechanics in a decentralized system.
I mean, it's wild to think about.
It is, because there are no circuit breakers in crypto. There is no central bank stepping in to stabilize the price of Toncoin. It is entirely driven by crowd momentum.
Yeah.
When millions of traders are looking at the exact same chart and they all fundamentally believe that $1.50 is a barrier, they all strategically set their automated sell orders at $1.49.
They build a massive sell wall.
Precisely. They build a wall of supply that overwhelms the buyers, causing the price to hit a brick wall right before $1.50.
Wow.
The collective belief in the barrier actually creates the physical market reality of the barrier.
The psychological herd mentality we see in crypto is fascinating because it's the exact opposite of what happens in highly illiquid physical markets.
Totally different world.
In crypto, belief creates instant liquid reality. But in physical real estate, belief can leave you completely trapped. Which brings us to our final story on the feed, buried in the celebrity microeconomy.
Yeah, this is where we see physical assets becoming incredibly expensive traps, even for Hollywood royalty with near unlimited resources.
The breaking news is that Ben Affleck, who is 53, has reportedly given his ex-wife, Jennifer Lopez, who is 56, his entire portion of their Beverly Hills mansion. And the headline actually says he gave it to her for free.
Well, anyone who understands finance knows that maintaining a bespoke physical asset is never free.
Absolutely not.
We need to look at the mechanics of this transaction, not the gossip. They purchased this extraordinary property for $60.9 million back in May 2023.
$60.9 million.
Right. And then they poured millions more into highly customized renovations to make it their dream marital sanctuary. And then they split up and spent over a year trying to offload it.
I should mention that this particular customized dream sanctuary happens to have 24 bathrooms.
Yeah, 24. What's fascinating here is this is a hyper-extreme textbook example of the sunk cost fallacy colliding with severe market illiquidity.
The sunk cost fallacy.
Yeah, it's that psychological trap where you refuse to lower your asking price or abandon an investment simply because you've already poured so much money into it.
You think, I bought it for $60 million, I put $10 million into renovations, I absolutely refuse to sell it for a penny less than $70 million.
Exactly. But the market does not care what you spent.
Nope.
You can have tens of millions of dollars in capital tied up, but your buyer pool for a customized 24-bathroom mega mansion in current economic conditions is incredibly narrow.
Yeah, I'm pretty sure my credit score just dropped from you saying that.
Right. If it won't move, your capital is utterly frozen.
And while that capital is frozen, you are bleeding cash. You are paying astronomical property taxes, bespoke insurance policies, and full-time maintenance staffs every single month just to keep the asset from deteriorating.
That carrying cost is the killer. Sometimes the absolute most rational financial move a wealthy individual can make is to simply walk away, abandon their equity, and give the asset away just to stop the monthly bleeding.
So what does this all mean? I mean, who actually needs 24 bathrooms anyway?
Nobody.
But seriously, it shows that no matter your net worth, you can't force the market to buy your baggage. Whether that baggage is an airline's terrible earnings report, a massive regulatory fine at the Supreme Court, or a sprawling Hollywood estate, the market dictates the terms.
Always.
And that brings us full circle. As you're listening to this, watching these global indices and charts pulse on NovaStream, I want you to see how intertwined these seemingly disparate events really are. Nothing happens in a vacuum. The price of the gas you put in your car today is inherently tied to the survival of the airline you fly tomorrow. The data plan on your cell phone is caught in a massive constitutional tug-of-war at the highest court in the land.
Yeah.
The Bitcoin in your digital wallet is riding the volatile waves of crowd psychology, and even the most elite celebrity real estate markets are bending to the same invisible forces of global tension and market illiquidity that affect everyone.
Before we wrap up today's live feed, I want to leave you with a final thought to mull over.
Okay.
We are watching a profound structural shift unfold across all these stories. If administrative agencies like the FCC potentially lose their historical centralized power to regulate massive telecom giants, and at the exact same time, untethered decentralized markets like crypto continue to rapidly expand their multi-trillion-dollar footprint.
Right.
Are we currently watching the rapid transition from an era of strict institutional control to an era where the decentralized crowd dictates all the rules?
Oh, wow. Now that is a mechanism worth thinking about the next time you look at a breaking news feed.
Definitely.
Keep questioning the data, keep looking for the hidden threads connecting the headlines, and we'll be right back here with you on NovaStream for another deep dive soon. Until